Welcome to our definitive guide for 2026. As we navigate the complexities of this decade, the strategy for long-term wealth has returned to its roots: quality and consistency. After the extreme volatility of the mid-20s, the global markets have entered a new era. The speculative fervor of previous years has matured into a flight toward stability. The Federal Reserve's recent policy shifts have created a unique environment where reliable yields are once again the primary anchor for portfolios. Investors are no longer satisfied with empty promises of future growth. In 2026, cash flow is the only metric that truly matters, and dividends are the ultimate proof of that flow. Today, I am breaking down the 5 dividend stocks I am buying most aggressively right now. This is a 10-minute masterclass on income growth and resilience. We aren't chasing the highest yields. We are chasing the highest quality. We want companies with wide economic moats and a culture of returning capital to you. Before we look at the stocks, we must understand the 3 golden rules of 2026 dividend investing. The first is the payout ratio. If a company pays out too much, they can't grow. The second is free cash flow. This is the lifeblood of any dividend. Without it, a payout is just a hollow gesture that can be cut at any moment. And the third is the dividend growth streak. A company that has raised its dividend through recessions and pandemics is a company that values its shareholders above all else. The 2026 outlook is cautiously optimistic. While inflation has cooled, the cost of capital remains significant, making efficient companies the clear winners. We are seeing a massive shift towards sectors like healthcare and enterprise software, where recurring revenue models provide a level of predictability that is highly prized. My strategy is to build a portfolio that thrives on this predictability. We are combining defensive staples with high-growth technology and cyclical media opportunities. Stock number 1 is the cornerstone of any modern income portfolio: Microsoft. In 2026, Microsoft is no longer just a growth play. It is a dividend growth machine. Its leadership in generative AI has created a new layer of recurring revenue through its Copilot and Azure services, which are now deeply embedded in the global economy. The sheer scale of its cloud infrastructure allows Microsoft to generate free cash flow at a level that most companies can only dream of. This is what fuels its payouts. Microsoft has increased its dividend for over 20 consecutive years. While the yield may appear modest, the growth rate is consistently in the double digits. I am buying MSFT right now because it is currently undervalued relative to its 5-year growth potential. It offers safety, growth, and a rising income stream. For long-term investors, Microsoft is the ultimate buy and hold asset. It is the perfect blend of 21st century innovation and 20th century financial discipline. Our second pick is the definitive defensive anchor, PepsiCo. In the current consumer environment, PepsiCo's portfolio of snacks and beverages is more valuable than ever. PepsiCo possesses incredible pricing power. When inflation fluctuates, the company can adjust prices without losing its loyal customer base. This protects its margins. As a dividend king with 53 years of increases, PepsiCo is a master of consistency. It has weathered every economic crisis of the modern era with ease. Its international segment is a major growth driver, especially as the middle class expands in emerging economies. This diversification is a key part of its stability. PepsiCo's yield is currently very attractive compared to fixed income alternatives. It provides a reliable base of income that you can count on every single quarter. I am buying PepsiCo for its resilience. It is a company that knows how to innovate while remaining true to its core products. It is a cornerstone of my portfolio. Stock number 3 is the undisputed leader in healthcare, UnitedHealth Group. This company is a fundamental compounder with a massive competitive advantage. Its Optum division is the secret to its success. By providing both insurance and healthcare services, UnitedHealth captures value at every stage of the patient journey. The demographics are undeniable. As the population ages, the demand for UnitedHealth's services will only increase, providing a multi-decade tailwind for the stock. UnitedHealth has a 16-year history of increases. Its dividend growth rate is among the best in the S&P 500, often reaching 15% annually. I am buying UNH because its current valuation does not reflect its long-term earnings power. It is a premium company trading at a significant discount. For those seeking a combination of high growth and high dividend safety, UnitedHealth is perhaps the best opportunity in the entire healthcare sector today. Our fourth pick is the infrastructure play of the decade, Broadcom. This is the company that literally connects the modern digital world together. Broadcom's semiconductor solutions are essential for artificial intelligence and high-speed networking. They own the critical intellectual property that powers data centers. The VMware acquisition has transformed Broadcom into a software powerhouse. This shift to recurring revenue has made its cash flows more predictable and valuable. Its dividend growth is legendary. Over the last 5 years, Broadcom has raised its payout at a staggering pace, making it a favorite for total return investors. Broadcom's management is incredibly disciplined about capital allocation. They only invest in projects with high returns, which ensures the safety of the dividend. I am buying Broadcom because it is the most efficient way to play the AI revolution while collecting a significant and growing dividend yield. Finally, our fifth pick is a unique high-yield opportunity, Nexstar Media Group. This is the largest owner of local television stations in the United States. Nexstar controls a vital piece of the media landscape. Its local news stations are the primary source of information for millions of Americans, providing an essential service. The 2026 midterm election is the massive catalyst here. Nexstar will benefit from record-breaking political advertising spending on its local stations. Nexstar currently offers a yield of over 4%. This is exceptionally high for a company with such strong free cash flow and a clear upcoming catalyst. Management is very focused on paying down debt and returning capital to shareholders. This discipline makes the high yield much safer than it looks on the surface. I am buying Nexstar as a value play. It is a cash-generating machine that is currently being ignored by the broader market, which is why it's on my list. Building this portfolio requires a strategic approach. You shouldn't just buy all 5 at once. You should build your positions over time using dollar-cost averaging. By combining tech, staples, healthcare, and media, you create a portfolio that is diversified across different economic drivers. This is how you manage risk. Risk management is essential. Always monitor the payout ratios. If a company's ratio exceeds 80% for several quarters, it may be time to reevaluate. Stay focused on the free cash flow. As long as the cash is coming in, the dividend is safe. If the cash flow starts to dry up, that's your warning sign to exit. Dividend investing is a long-term game. It is about the power of compounding. Reinvesting your dividends can double your wealth over a 10-year period. Don't be distracted by short-term market noise. The stock price may fluctuate, but if the dividend is growing, your underlying wealth is increasing. Patience is the most important skill an income investor can have. The market will test you, but those who stay disciplined are the ones who ultimately win. Think of your dividend portfolio as a garden. You plant the seeds today and you harvest the fruit years from now. You cannot rush the process. In 2026, the era of easy money is over. We have entered a period of normalization where quality is once again the most important factor in investing. Companies with strong balance sheets and consistent payouts will be the clear winners of this decade. These 5 stocks are your best way to play this trend. Always do your own research and ensure these picks align with your personal risk tolerance. The path to financial freedom is unique for everyone, but if you stay focused on quality and compounding, you will be well on your way to building the wealth you deserve. This is my 2026 strategy. These 5 stocks are my highest conviction picks for right now. I hope this deep dive has given you a clear map for your own income journey. Thank you for joining me for this 10-minute masterclass. If you found value here, please subscribe for more in-depth market analysis. To summarize, the 2026 dividend landscape is about resilience. By focusing on these high-quality leaders, you are positioning your portfolio for both defensive stability and powerful long-term growth. Stick to the plan, trust the fundamentals, and let time do the rest. Keep your eyes on the fundamentals, stay disciplined, and I will see you in the next video. Happy investing in 2026.